Hello everyone, welcome back to Stock Trading and Analysis. My name is Ming Han and I am part of a group who love to watch the markets for trading and investing. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Whether you're a beginner or seasoned pro, there's something here for you. Before I begin, a disclaimer that the info in this video is solely for education purposes, not a buy or sell call. Today, I will dive deeper into MACD by uncovering the math behind it and how we can use it effectively. At the end of this video, you will learn what MACD is all about, how I use it to avoid Apple's crash in August, and use it for yourself in future to avoid future sell downs. Let's go. MACD stands for Moving Average Convergence Divergence. Convergence is when MACD is moving in the same direction as prices. Divergence occurs when MACD is moving in the opposite direction of prices. MACD is also known as MACD. It was invented by Gerald Apple. He turned three moving averages into two MACD lines and presented them in a visual manner. The three moving averages used are the 12-day, 26-day, and 9-day exponential moving average. Exponential moving average is also known as a EMA. First, we need to understand how it is created. Then we will have clarity on how to utilize this wonderful indicator. To make things easier to understand, I will use EMA with the word average interchangeably. So when I say EMA or average, I am referring to the same thing. There are 5 items required to construct the MACD line and histogram. The formula is also mentioned here. The 12-day EMA, 26-day EMA, the MACD fast line, which is the difference of A and B, and the slow line, which is a 9-day average of point C, and last but not least, the MACD histogram, which is a difference of point C and D. For a start, we will talk about the MACD line first, appreciate its construction before we move on to the histogram. This is what a 12-day and 26-day EMA looks like. The 12-day EMA is the black line, and a 26-day EMA is the green line on this Apple chart. Moving on, these are the 4 items required to create the MACD line. This was mentioned earlier. The 12-day, 26-day, and the difference between A and B, and the 9-day average of point C. And you can see that the blue line is the MACD fast line, and the red line is the 9-day EMA, which is the 9-day average of the fast line. Before I dive deeper into MACD, an example of traders using moving average crossover can be illustrated here for a better understanding. When the MACD fast line is positive, it means there is a crossover. This means 12-day average is above 26-day average. On the 24th of January 2023, there is a moving average crossover, which is also when the fast line becomes positive. At this point of time, those who trade based on moving average crossovers will make an entry, but MACD will give you more insights. How so? Taking a 9-day average of the fast line, we are looking at the average of the fast line. This gives us insights into how the space between 12-day and 26-day average has changed over time. In short, the 12-day average and 26-day average are the average of the prices. The fast line is the difference between the average. The slow line is the average of the average. This is what it means. This slide shows you what it means. When the fast line, the higher the value, the more bullish it is. And the slow line is the average of the fast line. Each element goes deeper by looking at the difference in average and the average of the average. So what can this info tell you? This info tells you what is beneath the prices. Let me explain. On the 9th of January 2023, prices ticked up and the fast line went above its average. There is convergence here. Understanding the MACD's formula tells us two things. The fast line is negative because the 12-day average has not crossed above the 26-day average. Second thing, the fast line crossed above its average, the gap between the EMAs are closing, and there is a chance that the 12-day average will eventually cross the 26-day average. Traders who trade on moving average crossovers will be late to the game almost 2 weeks later. Traders who trade on MACD will notice that what is happening beneath the prices and pull the trigger first. Let's look at the chart of Apple for a bullish scenario. In May 2022, the 12-day average is below the 26-day average. Therefore, the fast line is negative. Prices made lower lows, but the fast and slow lines are making higher lows. This means the 12 and 26-day average are coming closer and a bullish crossover may happen soon. Price and MACD are diverging. This tells you beneath the iceberg, things are getting more bullish. This is bullish divergence. Subsequently, the fast line crossed above the slow line and Apple booms took control. What about a bearish scenario? Closer to date, in June to July 2023, prices went higher, but the fast line remains below the slow line. The undercurrent is saying price is not strong. Here we see the MACD and prices once again diverging, and subsequently bears took over. This is bearish divergence, and this is how I avoided the recent Apple crash. Now that you have gained a good understanding of the MACD and how it can be used, I'm going to show you the MACD histogram. The MACD histogram is the result of the MACD fast line minus the slow line. So when MACD fast line is above slow line, green histograms are drawn. When the slow line is above the fast line, red histograms are drawn. A recap to reinforce our understanding before we put it all together. 12-day and 26-day average, these are the average price over the indicated days. MACD fast line, the higher the value, the more bullish it is. Slow line, it is the average of the fast line. And finally, histogram is the difference of the fast and slow line. The Moving Average Convergence Divergence indicator, also known as the MACD, gives the trader more confidence when the histogram further reinforces the presence of a divergence. Finally, we refer to the previous bearish divergence. Similarly, MACD shows divergence in this case when the MACD lines and MACD histogram signal a potential bearish takeover. I hope this video gives you a better appreciation of MACD and how to use it. In summary, this video teaches you how to deploy MACD and trade better with it. I avoided the recent Apple crash with this indicator, and I believe it can do so for you too. As usual, indicators are not foolproof, hence professional traders do not use them in silo. Catch our other videos and see how MACD can be useful in your trading arsenal. That's all for today. If this video has been helpful, please subscribe, like, and share this video. Thank you and see you next time.